Contract administration does not begin when contracts are awarded, and project controls do not begin when costs start appearing in reports. Both disciplines begin when project teams decide how scopes will be packaged, how risks will be allocated, how work will be measured, how payments will be released, and how performance will be converted into reliable cost and schedule information. I want you to consider a practical question. Can project managers control contracts when estimators, planners, schedulers, cost engineers, procurement teams, construction teams, finance teams, and contract administrators are working with different structures? The answer is no. You may have detailed estimates, approved schedules, signed contracts, and sophisticated reporting systems, but without an integrated control architecture, those components produce activity rather than control. The central principle is straightforward. Contract administration, estimating, scheduling, cost control, cash flow forecasting, and project closeout must operate through common scopes, common work breakdown structures, common coding structures, common milestones, and common performance rules. When these interfaces are designed early, project teams can detect deviations before commercial exposure becomes difficult to reverse. When these interfaces are designed late, teams spend valuable time reconciling conflicting data rather than managing performance. Contract strategies must therefore begin with scope maturity and risk allocation. Lump sum contracts are appropriate when scopes, locations, interfaces, quantities, deliverables, and execution conditions are sufficiently defined for contractors to price the work without excessive contingencies. These contracts transfer greater cost risk to contractors, but they only work when owners have developed clear requirements and stable technical baselines. Unit rate contracts are appropriate when work scopes are definable, but final quantities remain uncertain. These arrangements provide flexibility, but they require disciplined measurement, inspection, quantity verification, progress certification, and reconciliation. Without strong quantity control systems, unit rate contracts can produce payment disputes, quantity growth, uncontrolled field instructions, and weak forecasts. Modified commercial arrangements can combine lump sum or unit rate components with reimbursable components. These structures may be useful when major work packages are defined while limited portions remain uncertain. However, every reimbursable element creates additional monitoring requirements because owners retain more cost exposure. Reimbursable cost contracts become relevant when scopes cannot be sufficiently defined, execution risks are unusually high, or early work must start before complete definition becomes available. These contracts offer flexibility, but they provide weaker natural incentives for productivity and timely completion. Cost reimbursable percentage fee arrangements require particular caution because contractor earnings can rise with expenditure. Fixed fee structures generally create better commercial discipline than percentage-based fees. Day rate contracts are frequently used for equipment, specialist personnel, temporary services, marine activities, drilling support, maintenance support, and other work with uncertain durations. These arrangements simplify time-based billing but provide limited schedule motivation. Strong utilization controls are therefore essential. You must know not only whether resources were present, but whether approved resources were productive, necessary, correctly classified, and deployed against authorized work. Contract types should never be selected through habit. Each selection must explain why the chosen structure matches scope maturity, quantity certainty, market capability, risk allocation, schedule urgency, measurement requirements, and administrative capacity. A contract that appears commercially attractive can become expensive when its control demands exceed the project team's ability to administer it. This is why project execution planning and contracting planning must be connected. Project execution plans should integrate approved scopes, technical approaches, contracting strategies, material strategies, cost estimates, milestone schedules, organizational responsibilities, staffing requirements, interfaces, and execution assumptions. Contracting plans should then translate those decisions into contract packages, procurement routes, bidder strategies, commercial models, award milestones, completion requirements, acceptance criteria, and payment provisions. Contracting milestones must be embedded within project schedules. Bid package preparation, tendering, technical evaluations, commercial evaluations, approvals, awards, mobilization, material delivery, construction completion, commissioning, and acceptance are not administrative side activities. They are schedule-driving events. When these activities are excluded from integrated schedules, projects create artificial completion dates unsupported by procurement and contracting realities. Payment provisions also influence cash flow timing. Advance payments, milestone payments, measured progress, retention, reimbursable invoicing, performance payments, and final settlements create different expenditure profiles. Estimators and schedulers must understand these provisions before cash flow forecasts can be trusted. Independent estimates provide another essential control. They test whether contractor proposals, amendments, claims, and change order quotations are commercially reasonable under prevailing market conditions. These estimates should be prepared independently from contractor proposals, protected from unnecessary disclosure, and based on the same defined scope, quantities, productivity assumptions, rates, indirect costs, escalation logic, and execution conditions. Competitive bidding does not automatically eliminate the need for independent assessment. Several bids may still be based on shared misunderstandings, incomplete scopes, market shortages, unbalanced pricing, or aggressive assumptions. Strong bid reviews examine technical compliance, exclusions, qualifications, schedule feasibility, resource plans, commercial conditions, unit rates, payment terms, escalation provisions, and lifecycle consequences. Bid review teams should combine contract representatives, technical specialists, estimators, cost engineers, planners, schedulers, finance representatives, industrial relations specialists, procurement personnel, and operational stakeholders when required. Technical recommendations and commercial recommendations must remain traceable. Low prices should not override unacceptable technical risk, and strong technical proposals should not excuse commercially uncontrolled commitments. After contract award, authorization must remain aligned with scope, budget, and schedule. Work release mechanisms provide disciplined methods for authorizing defined portions of broader service, engineering, program management, or reimbursable contracts. Each release should identify the approved scope, deliverables, work breakdown structure, quantities, planned start and completion dates, man-hour budgets, allowable costs, organizational resources, and contractual references. Owners and contractors should agree the release scope before commercial approval. Owners should then prepare independent man-hour and cost estimates while contractors prepare separate proposals. These estimates should be compared using productivity norms, historical performance, project complexity, resource grades, escalation assumptions, indirect costs, travel requirements, subcontracting needs, and delivery schedules. Work should not begin before authorized signatures, adequate expenditure authority, approved budgets, and defined completion requirements are in place. Informal instructions create commercial exposure because contractors can reasonably claim compensation for requested work even when internal authorizations remain incomplete. Resource organization charts should identify approved positions, classifications, mobilization dates, demobilization dates, reporting lines, salary codes, and planned durations. These charts must remain current throughout performance. Without resource-level transparency, reimbursable contracts can accumulate unplanned personnel, extended assignments, grade substitutions, overtime growth, and indirect cost expansion. Every work release should represent a distinct and measurable work breakdown structure. When funding is limited, projects may authorize defined portions on not-to-exceed bases, but the complete scope and remaining boundaries must still be understood. Funding constraints should limit authorization, not obscure scope. Cost control starts with estimate structure. It does not start after purchase orders, invoices, and commitments begin accumulating. Project teams must design cost structures while estimates are being developed. Approved budgets should be divided into appropriate job orders, work packages, phases, disciplines, cost categories, contracts, materials, support activities, and responsible organizations. A standard code of accounts creates the common language required for this integration. It allows estimates, budgets, commitments, purchase orders, invoices, progress measurements, forecasts, schedules, changes, and final costs to be compared using consistent classifications. Unique coding reduces omissions, double counting, inconsistent reporting, and uncontrolled transfers between cost areas. engineering costs, construction support costs, indirect construction costs, civil works, structural works, equipment, piping, electrical systems, instrumentation systems, painting, insulation, materials, contractor services, internal labor, equipment usage, and miscellaneous direct costs should remain identifiable at appropriate levels. Excessive detail creates administrative burden, but insufficient detail hides emerging problems. Project teams must choose coding depth according to risk, reporting needs, contract packaging, work package accountability, and forecasting requirements. Cost categories and entry codes should also distinguish contractor engineering, owner engineering, construction contracts, technical services, internal labor, equipment usage, direct materials, warehouse materials, project-specific procurement, transportation, temporary facilities, supervision, and shared indirect costs. These distinctions support audits, forecasts, benchmarking, trend analysis, and future estimate development. Coding structures must be applied consistently across engineering documents, material requisitions, purchase orders, contracts, work releases, field instructions, change orders, invoices, and financial reports. When contracts use one breakdown, schedules use another, estimates use a third, and accounting systems use a fourth, reconciliation becomes a recurring project activity. That situation does not represent integration. It represents delayed uncertainty. Estimating and scheduling must operate as reciprocal disciplines. Estimators provide quantities, productivity assumptions, crew compositions, man-hours, material lead times, construction methods, indirect resource requirements, and cost distributions. Schedulers translate those inputs into durations, sequences, logic relationships, resource demands, milestone dates, and expenditure timing. Schedulers then provide information back to estimators and cost engineers. Changes in plan durations affect supervision costs, temporary facilities, equipment rentals, escalation, staffing, overheads, and cash flows. Changes in quantities or productivity affect manpower levels, activity durations, completion dates, and indirect costs. Every significant cost change should be tested for schedule effects, and every significant schedule change should be tested for cost effects. Project teams should reconcile cost-loaded schedules with approved estimates. Planned values should align with authorized budgets after appropriate exclusions such as management reserves or contingencies. Engineering, procurement, construction, commissioning, and closeout expenditures should follow realistic execution sequences rather than mathematically convenient distributions. Cash flow forecasting converts project plans into funding requirements. Accurate forecasts show how much money will be required, when it will be required, and which cost elements will create those requirements. Weak cash flow forecasts can delay approvals, constrain procurement, disrupt contractor payments, distort portfolio decisions, and create avoidable funding emergencies. Cash flows should reflect engineering progress, procurement commitments, manufacturing schedules, material deliveries, construction progress, payment terms, retention rules, change exposure, and forecast completion dates. Forecasts must be updated when scope, schedule, productivity, contract values, or procurement strategies change. Management should receive early visibility of future funding pressure rather than explanations after expenditure limits are reached. Effective controls compare budgets, commitments, accruals, actual expenditures, approved changes, pending changes, forecasts, and remaining risks. These values answer different questions and should never be treated as interchangeable. Actual expenditures show what has been paid. Commitments show contractual obligations. Accruals recognize work performed but not yet invoiced. Forecasts estimate final outcomes. Pending changes reveal exposure not yet fully authorized. Contract administration must therefore remain linked to change management. Every proposed change should define technical reasons, scope boundaries, schedule effects, cost effects, risk consequences, required approvals, funding sources, and contractual entitlement. Change order logs should show initiation dates, current statuses, proposed values, negotiated values, approved values, implementation dates, and forecast impacts. Projects lose control when field teams direct changes before scope, cost, schedule, and authorization consequences are understood. Some urgent instructions may be unavoidable, but even urgent changes require written records, defined limitations, responsible approvals, and prompt commercial evaluation. Performance data should be captured throughout execution, not reconstructed during closeout. Projects should track planned quantities, installed quantities, earned progress, expended man-hours, productivity rates, forecast man-hours, approved budgets, actual costs, schedule performance, resource trends, and major causes of variance. Closeout completes the control cycle. Final cost reports should capture contract values, change histories, unit rates, man-hour rates, staffing curves, expenditure curves, schedule results, engineering performance, procurement performance, construction productivity, support costs, inspection costs, major disruptions, claims, lessons learned, and final outcomes. The purpose is not administrative completeness. The purpose is institutional learning. Reliable closeout information improves future estimates, schedules, contracting strategies, productivity norms, risk allowances, cash flow models, and bid evaluations. Organizations that fail to close the data loop repeatedly price new work with incomplete memory. Your practical test is therefore simple. Ask whether every contract scope maps to an estimate, every estimate maps to a cost structure, every cost structure maps to a schedule, every schedule maps to cash flow, every work authorization maps to approved funding, every invoice maps to measured performance, every change maps to forecast impact, and every completed project contributes usable historical data. When those links exist, contract administration becomes an active management system rather than a document processing function. Project controls become forward-looking decision support rather than retrospective reporting. Estimators, planners, schedulers, cost engineers, contract administrators, procurement teams, finance teams, and project managers begin working from the same execution model. When those links do not exist, reports may still look complete, but decision quality declines. Costs appear without clear scope ownership, schedules move without corresponding forecasts, changes accumulate outside control baselines, invoices arrive before progress can be verified, and closeout records fail to explain final outcomes. I encourage you to examine your current projects through these interfaces. Do not ask only whether contracts, estimates, schedules, and reports exist. Ask whether they reconcile, whether responsibilities are clear, whether authorization boundaries are visible, whether performance is measurable, and whether forecasts reflect current execution realities. For support in developing integrated contract administration frameworks, cost control structures, estimating interfaces, scheduling systems, work release processes, change control workflows, and project closeout models, get in touch. Like this session if it improved your understanding, share it with project managers, contracts engineers, estimators, cost engineers, planners, schedulers, procurement professionals, engineering managers, construction managers, and finance teams. And subscribe to the channel for more engineering management education and training. Follow my LinkedIn newsletter for detailed engineering white papers, implementation frameworks, management insights, and practical project control guidance.